Okay, this is the 3-1 notes. We're going to be doing it the payroll register and employee earnings record. We're going to be talking about net pay, taxes, accumulated earnings. We're even going to throw in some commissions this time. So these are some learning just how the employees are paid, how we got to calculate the earnings for each employee and prepare some payroll reports. Basically, like what we've talked about, any amount that the employee gets paid is kind of wage. If you don't get paid hourly and you get paid a salary that's divided by equal pay periods, that's going to be called a salary. Either way, a business has to record the payrolls uh, and pay taxes on these. For what we're going to be dealing with mostly is going to be hourly wage employees. So we'll be learning or figuring their regular earnings, their overtime earnings, which we'll get to, and then taxes and things like that on top of that. They kind of talk about managers and things, how they might be salary and not part of the commissions and this and that. So that's what they're talking about. Federal state laws require employers to keep accurate records, and so payroll records are maintained for the business for each employee. Okay, number of days a week recorded covered by an employee's paycheck is the pay period. It might be paid weekly, bi-weekly, monthly, depending on what company business you work for. Total amount earned by all employees for the pay period is called the payroll. If you remember last semester, last year, we had a payroll account that was paid out of the general account. We wrote a check so that we would have it equal, and we'll talk about that later. Taxes based on the payroll of businesses are called payroll taxes. Um, we're going to have to withhold certain taxes from each person throughout the pay period. This isn't, something they kind of do or they just think about doing, and it's required by law. They kind of mentioned that. Periodically, employers will pay government agencies these taxes. We'll learn more about that as we move along. Businesses need to provide yearly reports showing the total salaries earned. That's true. Yes, they have to. And all the total taxes withheld. Basically, if you have a job, you'll get a W-2, and they get until the end of the month after last year. So you worked through December 31st. By January 31st, you have to have this. So like our school, Urbandale High School, gives me this form, and they have to give it by May 31st. Usually they give it to you about halfway through. This is just a chart of payroll deduction by a company. They got all the pay and then the taxes, but you can look at that. Again, they're required by law to withhold certain taxes, federal income tax. Um, Not all states have state income tax. We do. So they don't list that right there, but two FICA tax, we'll have to take Social Security tax and Medicare tax. You probably remember that. FICA is abbreviation Federal Insurance Contribution Act. I think that's on the test, but just something for you to know. If you remember the charts that we'll get to in a minute, as total earnings, if they're married or single, we had two different charts. Number of withholding allowances by each employee determine the federal income tax that will be withheld. Deductions from total earnings for each person legally supported by a taxpayer is called a withholding allowance. So the more allowances you withhold or claim, the less tax or the more tax. You just got to kind of see, and we'll show you the difference between what like a single person with one allowance versus a married person with one allowance, how much tax is being taken out. It just depends. Some people want more money in their check, so they'll take less taxes out. Some people want less money in their check, so they don't have to maybe pay at the end. They won't get it, and so they might get a bigger refund. It just kind of depends. So these allowances we'll look at, but it's going to be based on your earnings, your marital status, and the number of withholdings. FICA, this Federal Insurance Contribution Act, that is Social Security and Medicare. Social Security is old age survivors disability insurance portion of that FICA. Medicare is the hospital insurance portion. They'll ask you um, those on the test. Maximum amount of earnings on a tax that's calculated is going to be called tax base. So, for example, you're not going to be paying the Social Security tax for every dollar you earn. You're only going to pay Social Security tax for all earnings up to 128,400. That's a different number than um, we had in accounting one. Accounting one, I think we had 87.5 or something like that. So what they're going to do is they're going to take all the earnings you made times 6.2% for up to a max of earnings of 128. Once you make $128,401, that $1 will no longer be, since it exceeded that number, it will no longer be subject to Social Security tax. Medicare, on the other hand, the insurance portion does not have a tax base, and Medicare is your total earnings times 1.45%. So when you put it in the calculator, it'll be 0.0145. Laws vary from state to state, city to city for taxes. California, New York have the most programs, most people, the most people without jobs. They have more taxes. It just kind of depends where you live. Urbandale has a little less property tax than Waukee. Waukee keeps building schools, so they keep adding. It just kind of depends. Every place is different. That's what they're getting at. You'll see that later. Other businesses will take deductions for health insurance, life insurance, retirement plans, charitable contributions. You won't have to figure these. They'll be given to you. If they say they keep $50 in life insurance a month or a pay period or whatever, they'll tell us those things. Okay, so this is a pretty involved section here. We're going to be talking about these time summaries, these time cards. Basically, this is an employee's names listed here, their ID numbers, their pay periods, how many hours they worked, if they worked over 40 hours, and we'll talk about that. Wiley, our example, pays hourly salary people biweekly. Biweekly period is considered to be 80 weeks, 2 40-hour weeks. A regular work week is 40 hours a week. If you work 41, you would have overtime. If you work 43, you'd have 3, and so forth. If you just work 40 hours a week, you will not have overtime. They talk about identification codes. You slide you used to punch in, then you slide a card, or you put a code in the computer, and that records everything for you. Here again, it talks about if you're in excess of 40 hours a week, it's considered overtime. You get paid what's called time and a half, or 1.5 times, like it says here, the hourly rate. So if you work overtime, so here, regular hours, 40 hours a week, 2 weeks is 80, times what you're getting paid, $18 an hour, you get that much money. If you worked 4 overtime hours, okay, times the regular rate, 18 times 1.5, because this is the time and a half. If you work overtime, you get rewarded in this company by getting the extra pay, time and a half. Now, another way to do this, if you got a calculator out, so you would multiply 4 times 18 times 1.5, and you get the 108. What we always were taught, I don't know why, but what's half of 18? 9. 9 plus 18 is 27. You get the same thing. Just one less step, but whatever, because you can do it in your head if there's decimals, whatever. Just showing you don't get tested on that. But either way, you get paid extra for the overtime hours, so that's why we have this extra. You add the regular earnings to overtime earnings to get total earnings. Okay. The commissions record, it just kind of depends. You have your employee number, date. There's a different time departments. He's in the grills department, but there's also furniture involved here. Regular biweekly salary. Then they get paid commission. Excuse me. They get paid commission, so they have these different sales. So they get the sales on account, accounts receivable, plus their cash credit card sales to get totals for each department. Then they subtract discounts, returns, and allowances for each department. So these are the sales minus the returns and allowances to get net sales for each department. Each department then has a commission, and they talk about it later. Some of these commissions are based on that's a little harder to deal with and more things involved with furniture. So you might have a higher commission. They see it as a more important or whatever. Maybe the company makes more money and they want to push that product more, so they'll pay more commission, whatever the case may be. Commission is just extra pay that you earn based on the sales of the company. And in our departments, we have two different departments here. So you would take 3% of that and you would get the commission that they would make. And so this is called a commissions record. You would add the commission from the grills department plus the commission from the furniture department. A lot of these numbers be given to you. You might have to add these. You might have to add these, and you might have to subtract. Take this number and subtract this number to get a new total for net sales. You might have to multiply to get the commission, and then add the two commissions to get your total commissions. And they talk about it here, so you can read through that. I'm not going to read through that. Employees may receive commissions, cost of living adjustments, share profits, bonus. Yes, that happens. It just depends what company you're working for, what type of company. To encourage increased sales, that's why they offer commissions. Have the people work a little bit more. This explains why they get different commission sales. It's nothing that's something you need to do. I don't have it up. Sorry. Okay, so the payroll register and earnings record, where you can get these, because you can't see this, so when you click on here, it can enlarge, and it should, and then you can drag it to your desktop, and you can see it a little easier, or you can look at it here and scroll sideways. I'm not sure why it's buffering so much, but this register is what we're going to look at. Anyway, it will come up here, drag it to the desktop. You want to see it a little bigger. So the payroll register is what we're going to be talking about preparing. They have all the different steps here. Excuse me. The date, the payroll is, ending pay period. So this is the last day you'd work. This is when it actually is paid. There's a little bit of buffer to get it prepared, write the check, get it. So that's why it's a little different. But this is the end of the pay period. It has all your employees. It has their marital status and their allowances they record for tax purposes when we figure out the federal income tax. There's a section of earnings here, which has regular earnings, a 40-hour work week, or less than that, I guess. Your overtime earnings, if they worked over 40, what that calculated to, excuse me, and then commissions for some that earned commissions. You add up their regular overtime commissions, whatever the case may be, to get a total earnings. Then each department then would have some numbers here where we would then take also, there's administrative, that gets earnings that you would have, grills, furniture, and we want to keep totals of these for our purposes for taxes later on. Federal income tax, state income tax, Social Security, Medicare, health, retirement. The health and retirement will be given. State income tax will be a certain percentage of their total earnings. Federal income tax will be based on their marital status and a number of withholdings from their total earnings. You're also going to get total subtractions of the deductions. So once we find all the deductions, we will get a total. We would subtract that number from the earnings to get net pay. Okay. And that's all that is. So what we want to do, and then you're going to have to add all these up. And this is the total net pay that would then be written in a check to the general account or the payroll account out of the general account to the payroll account to pay the checks. In order to go through all that, that's all going to be right here. And all the steps are here. So employer name, number, number allowances, marital status, the earnings, excuse me, your total. And I guess I can show you this while it's up here. You get the total earnings. So it tells you to add those two numbers up, okay, to get total earnings. It has all these different taxes, and we'll show you about how you get these here in a second. Federal income tax withholding tables. There's a single and a married table. And where you get them, you just scroll down. I just clicked on the link. It just takes you down to the bottom. So if they're single, the number of holdings are up here, and the area of which their earnings would fall under, you would find it if they work, this. So this says 1,000 to 1,020. So if they made $1,010, you go here, and if they had two allowances, you go over, and you would say that $58 of federal income tax. Now you got to be careful. It says less than 1,020. So if it's 1,020, you got to go to this one that says at least. It really should just be 1,000 to 1,019 there, but just be careful. If it's single, you go to that chart. If it's married, you go to here, and this is the example we have where that falls in this range, and he's married. They're married with two employees, or two allowances, excuse me, so the tax goes to 104. As you can see, the more allowances, the less taxes you get taken out of your check. The less allowances, the more taxes taken out. If you get a lot of allowances, then you might have to pay taxes later at the end of the year. It just depends on your deductions and your income level, and you'd have an accountant talk to you all that. We don't need to really worry about it. The one thing you want to remember kind of is the more allowances, the less tax taken out. If you can see here, a single person will have more taxes taken out than a married person. Excuse me. All right. So total payroll deductions, you got 104. That's what we just looked at. That's where that 104 number came from, the federal income tax withholding table. State income tax is $44. Where do you get that? It operates from this idea: 2.5% of your total earnings is getting taxed by the state. Social Security is figured here, total earnings times 6.2%. They're under the tax base that we talked about previously, the 128,000 tax base number, whatever it was. So we're taking the whole earnings times Social Security to get Social Security tax. We're taking the total earnings times Medicare tax. Medicare tax does not have a tax base. So that's where we get these. Okay. The other numbers, health insurance and retirement plan, will be in instructions or be already written in the chart for you. So you don't have to figure those out. But that's where you get all those numbers, and they show you it here. This is supposed to say dollar. I don't know why it's a typo, whatever. So you take the total earnings minus all these deductions, which again are listed here. You get your total deductions minus your total earnings to get net pay. And that's what they're doing there. So that number 137,723, 137,723 is from here. So what your job will be is to record all these deductions, figure out if they get overtime, regular pay, commissions, get the totals, and then subtract total earnings, and then subtract the total deductions from it to get net pay. And that's the check that you would cut, and that's the check number there that you'd see there. So that's what they're talking about here. To figure out at the end, excuse me. So subtract total deductions, $2,827.50, $2,827.50 from the total earnings to get net pay. All this is going to be done. This form, the payroll register, is what we're summarizing our earnings deductions for. Wiley prepares a separate payroll register for each biweekly payroll. Okay. That's a question because they say biweekly means what? Twice a month, every 2 weeks. This is telling you down here how to read that table that I just talked about. So it's telling you go to the married table, 2 allowances, and look in between at least this section, but less than. At least this section less than the married and 2 allowances. So that's just explaining how you do those charts. The employee's earnings record then is here for us, and it is the one person who has your employee number. You do this at the end of the month. They get paid twice. This is the first pay period. Excuse me. So we're writing down the earnings that they had. They got commissions, total earnings. They found this total earnings 1759.56, 1759 or 86, 86. Sorry, put that number there, and it's just an exercise in retyping things right now. Total earnings is found. Put it on the earnings record. Federal income tax, state income tax. All these deductions are listed here. And you get the total. You already have it, so you don't need to add it up. You already have the net pay, which is subtracted total pay or total earnings minus your deductions. So you get your total net pay. All right. And they talk about how you go about doing this and in these steps. And so hopefully you see that. So they say total current earnings for the pay period 1,759 plus accumulated equals the new accumulated earnings. So this is a previous number from the last month. We'll do 2 different sets here for each pay period. This is the first pay period that we just did. They got paid $1,759.86. That's what's listed here. They have accumulated earnings of $20,640, so you get your new accumulated earnings. Common mistake is just adding net pay, but accumulated earnings is all the total earnings they made before deductions. So all the accumulated earnings that they previously earned plus this pay period's total earnings equals the next accumulated earnings. And that's what we're talking about. And this form is just what's showing all these details from this employee, certain employee. This is one employee's card. And you're just taking that information from the payroll register. And this is called the earnings, employee earnings record. We will record each one of the, we'll prepare a new earnings record each quarter. That's why it says for record for quarter ended. So January, February, March, those 3 months of a quarter. April, May, June, quarter, so on. Every 3 months is a quarter. Accumulated earnings refers to year-to-date earnings. I don't believe that's a test question. It's something to kind of talk about. And so that is the notes for this section.